Welcome to Alpha Recap, your post-market deep dive from stockalpha.ai. We're looking back at the day's moves, unpacking what mattered and why it could matter going forward. As always, if you have questions, you can reach us at stockalpha.ai and ask us directly. Today I'm joined by Ben, our commodities and markets expert. Thanks for being here.
Thanks for having me. Excited to dig in.
Big headline to kick things off. The S&P 500 crossed the 7,000 mark today. And that came as big tech earnings kicked off, with Netflix among the early reports. The headline felt symbolic. What jumped out to you?
Yeah, that was the big visual. The index crossing 7,000 is part technical and part psychology. It tends to draw flows from momentum and quant strategies that pay attention to round numbers. But underneath, it reflected real earnings momentum and risk-on positioning across asset classes.
The number itself matters to algos, but not all of us are algorithms. So, what really stands out here is the combination of headline momentum and earnings starting to drive sector rotation.
Exactly. I mean, when you step back and look at this, the move past 7,000 was less a pure macro signal and more a confirmation that market breadth was holding up into earnings season.
Quick reaction. Big move.
Yeah, that tracks.
Let's turn to earnings. PepsiCo reported today and beat on both the top and bottom lines. Non-GAAP earnings per share came in at $1.61, beating by about 6 cents. And revenue was about $19.4 billion, beating by roughly $500 million. Ben, how should listeners interpret that kind of beat from a defensive staple?
Pepsi's report was meaningful because it reinforced pricing power and demand resilience in staples. Beating both earnings per share and revenue by those amounts suggests volume and pricing worked together. But a couple of caveats. It was a non-GAAP number, and we need to watch how sustainable those pricing gains are as commodity costs and pricing elasticity evolve.
Right. And the other thing is a beat like that can anchor defensive allocations if volatility picks up.
For income and defensive investors, that's the takeaway. Staples still play a role, but folks should dig into recurring cash flow quality behind those non-GAAP adjustments.
Switching gears to regulatory headlines, the European Commission asked Google to share search engine data with competitors. That got a lot of attention today. What's the realistic impact here?
This is a potentially high-impact regulatory move because Google's data is central to ad targeting and relevance. Forced sharing could, over time, erode parts of the advertising moat. But implementation is thorny. How the data is shared, privacy constraints, latency, and whether it's aggregated or raw all shape the commercial outcome. So analysts tend to view this as a multi-year risk, not an immediate revenue wipeout.
So there's a spectrum of views. Some see structural risk, others point to implementation friction slowing any impact.
Exactly. And the market's reaction is pricing in that uncertainty. Analysts are split on the pace and magnitude of any ad revenue hit.
Let's talk idiosyncratic noise. There were a bunch of 8K filings today and a high-profile short report on Poet Technologies. The Wolfpack research piece focused on a foreign tax classification technicality, and the stock dropped from about $7.60 at the open to about $6.60 within an hour. That's a big intraday swing.
It was a classic short seller move. The tax technicality they flagged is real, in the sense that classification matters. But several analysts pushed back, saying it didn't touch the core photonics technology or the longer-term commercial roadmap. Short reports can be narrative-driven, and they can move price fast, but sometimes the fundamental impact is limited.
Honestly, I was a bit surprised by this one.
Yeah, and the other thing is those governance and disclosure filings, like the 8Ks from Prime Medicine, Highcroft Mining, Mira GTX, Global Net Lease, and Transocean. They don't always mean catastrophe, but they do increase short-term liquidity and sentiment risk. Traders pay attention.
Short, simple reaction. Not what anyone expected.
Mm-hmm.
We also saw momentum names perform today. Palomar Holdings is trading around about $130.05, and it's up about 15.5% over 6 months, outperforming the S&P by about 10.4%. AMC Networks jumped to about $8.04 after a strong quarter, roughly a 10% intraday move. and it's outperformed the S&P by about 5% over 6 months. How do you read these rallies?
Those are classic momentum stories. Market participants tend to reallocate into names that show operational traction. But analysts uniformly caution that you need to interrogate the drivers. For insurers like Palomar, underwriting discipline and capital deployment matter. For media names, content economics and distribution are the core questions. Momentum can persist, but durability depends on fundamentals.
And that feeds into the broader debate. Is crossing 7,000 a green light for more risk, or a reminder of concentration and regulatory crosscurrents?
There's divergence. Some view it as confirmation of breadth and a cue to increase cyclical exposure. Others point to the concentration in big tech and the regulatory clouds we just discussed as reasons for caution. The sensible approach is scenario planning. Map out outcomes for regulatory shocks and for earnings surprises, both positive and negative.
Quick pause. Hold on. Say that again.
Scenario planning. Don't rely on a single narrative. Put probability on a range of outcomes and track the high-frequency signals that would change your view.
So, what really stands out here is that headlines can amplify short-term volatility, but fundamentals still matter in the medium term.
Right. And to add to that, active traders and event-driven managers will find opportunities in earnings beats and intraday swings, but execution risk is higher. Long-term investors should separate headline noise like short reports from durable operational trajectories, and income investors should watch recurring cash flow quality behind non-GAAP measures.
Let's close with clear takeaways. Then, what are 3 or 4 things listeners should remember from today?
First, the S&P crossing 7,000 is meaningful for flows and sentiment, but interpret it alongside concentration and earnings breadth. Second, regulatory moves that touch core data assets, like the European Commission's request around search data, are multi-year risks. Monitor enforcement mechanics, not just headlines. Third, idiosyncratic events like the Poet Short and multiple 8K filings can create outsized, often transient price moves. Follow filings and subsequent confirmations. Fourth, earnings beats in staples like Pepsi's $1.61 and about $19.4 billion in revenue reinforce defensive allocation themes but require scrutiny of non-GAAP adjustments.
Perfect. Final quick reactions? Yeah, absolutely. Right. Thanks, Ben. If you enjoyed this recap, remember this is informational only. Analysts note and data suggest, but this is not personalized investment advice. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. We'll see you next time on Alpha Recap.